Hello, good morning, good afternoon, good evening, depending on where you are in the world. I'm Nicolas Veron. It's my pleasure today to introduce this new session of the Financial Statement series at the Peterson Institute for International Economics. And indeed, it's a big tech week at the Peterson Institute. Caroline Atkinson yesterday had a session, which I hope you watched live and is now available in replay mode on the Peterson Institute website with Reinhilde Vögelers and Diane Coyle. On the international coordination aspects of big tech regulation. And we'll look today at basically the same issue, but from a slightly different perspective, because this is the financial statement series. And so we'll look at it from the standpoint of financial regulation, but very much looking at in a holistic manner. And we couldn't have better speakers for that than the two guests of the session today, Hyun Song Shin and Rory McFarquhar. Yoon Shin is the chief economist at the BIS, a position he has occupied for almost 7 years, since May 2014. So the exact title is Economic Advisor and Head of Research at the Monetary and Economic Department of the Bank for International Settlements in Basel. He studied at Oxford in the 1980s. He was a fellow he became a fellow at Malden College in 1988. And in 1994, he became a professor at University of Southampton, then back at Oxford in 1996, and at the London School of Economics in 2000. So very strong UK background, and he was also an advisor to the Bank of England from 2000 to 2005. Then Hyun moved to the US. He was at Princeton from 2006 to actually when he joined the Basel Bank for International Settlements. 8 years later, he was also a member of the Financial Advisory Roundtable of the Federal Reserve Bank of New York in the late 2000s. So continued involvement in economic policy. And actually in 2009, 2010, he spent a year in Seoul in South Korea as chief advisor to President Lee Myung-bak on international finance. And that was the moment when South Korea held the presidency of a very momentous year for the G20, maybe more momentous than in more recent times, but not for me to judge. Hyun Shin's research is so prominent, I should almost say dominant, that I'm not going to try to summarize it. But one bit that I particularly like is his interest in financial history, because I think we need a lot of that. And together with Isabel Schnabel, which will hopefully be a guest of this series later this year, he wrote in the early 2000s a very noted paper on the financial crisis that followed the failure of the bank of Leendert Peters de Neuville, who was at the time a famous Dutch financier. That was 1763, and it feels like yesterday. Rory McFarquhar is a former First things first, a former fellow at the Peterson Institute, had also a distinguished career in public policy and more recently in business. He studied at Yale, had a master's at the London School of Economics, worked in Russia in the 90s and 2000s, initially with the team around Jeff Sachs at the think tank called the Russia-Europe Center for Economic Policy in Moscow, also for Goldman Sachs in the 2000s for a number of years. And then he joined the US Treasury in 2010, 2011. That's when we first met, from which he moved to the White House as special assistant to President Obama and senior director at the National Security Council, dealing with a lot of issues that echo what we are going to talk about today, including in the context of relationships with China and other parts of the world. He was at the Peterson Institute in 2016, 2017 as a visiting fellow, and then he joined Google until 2019, and since May 2019, MasterCard, where he's a senior VP. So lots of different perspectives with our two guests, and with this, I'll hand it over to you, Hyun.
Well, thank you, Nicola. Thank you for that introduction. It's really a pleasure to join you and Rory on this occasion. Let me see if I can share my slides. I have some I have a few slides just to seed the discussion. This is a very quick look at some of the key issues that I think have arisen recently in the regulation of big techs, especially in their activities in financial services. Financial services constitute still a relatively small portion of the revenue that go to big techs. If you look at this pie chart, it's that light blue. It's only around 11% of total revenue that is derived from financial services. But I guess the reason why we're here today is big techs do have the potential to make a much bigger impact in financial services, and that is because of their particular business model, which is to utilize their existing businesses either in e-commerce or social media or search, and utilize the data that is generated from their existing activities to give them a competitive edge. The way that we have characterized this in our work in our annual economic report in 2019 is to call it the data network activities loop, or the DNA loop, which is the idea that data is the raw material, if you like, but then the data is combined with the network effects that arise from the particular business model, which relies on the direct interaction of users. And the data is an essential byproduct of that interaction. And the idea is that as that interaction takes place, this gives rise to more activity, which then gives rise to even more data, and then the circle is completed. So the DNA loop is clearly a force for greater financial inclusion, because you can include more people for the provision of financial services, better information. And then this leads to better services and, of course, lower costs. The other side of the coin is that the same network effects that lead to these benefits has the potential perhaps to erect silos or indeed the walled gardens, as people like to say. And the walled gardens, and this is a sort of figurative way of saying that once you're in the walled garden, it's very nice and it's very pleasant, but then the competitors are outside. It's now a much greater challenge for competitors to breach that wall and to compete in providing better services. So I guess, just pursuing this analogy, breaching walled gardens, maybe one one issue that policymakers would want to consider. And what I wanted to do was to just give you two examples, just to see the discussion. One from payment services, and the other one in credit intermediation, and both have been very much in the news. In the case of payments, perhaps one way of breaching that walled garden would be through a combination of data access policies and common technical standards for data transfer, as a way to channel the network effects from something which could entrench monopoly power to something which is much more virtuous. And I think this is something that has been very much in the news in the sphere of payment services. So, one way to think about this is by the analogy with this market setting. And here's a picture of the public square in Basel, where you see the market stallholders, mingling with the public. And the idea is that if you have sellers who offer differentiated goods, this will attract more consumers, and because of this two-way interaction, the sellers could actually, the entry of new sellers could actually make other sellers better off if that greater variety induces more customers to enter. And from the customer's perspective, of course, this is something that will benefit them twice over because they have better services and better variety. And we follow this analogy in the special chapter that we published last year. And the idea is that one way of breaching this walled garden is through a combination of data portability and this technical standard, in particular, these so-called APIs or application programming interfaces, which set a common technical standard. So data portability is familiar from the data privacy discussion in the EU. There is a GDPR rules, for example. But portability by itself is probably not going to be sufficient to inject competition. For example, if the portability is in terms of a data dump, let's say they give you a very big PDF file of all your data, that's probably going to be less useful for competitors to use. But if you were to combine that with a common technical standard for data transfer, this would certainly promote interoperability, which is the idea that technical platforms can actually communicate with each other. And in the case of payments, there are two particular aspects of that. One is the so-called account information service, where the individual user gives consent to competing payment service providers to access the data held by the existing service provider. And the second aspect is what's called the payment initiation service, where any user can authenticate who they are from third-party platforms within the same broad system, so that you're not obliged to use the same the single point of entry. And this has been the model in many of the fast retail payment systems that have been rolled out around the world. For example, it's kind of the guiding philosophy in the European Union's PSD2, the Payment Services Directive 2, as well as the approach in the UK, for example. And in several countries, these systems are already operating, especially in Asia. The one in India has been well cited, but also in Korea, Singapore, and also lately in Mexico and Brazil as well. And the idea is, if we push this analogy further, we can think of the central bank's settlement accounts as the public square where this kind of open market can take place. And it's if you like, more than an analogy, because the settlement accounts, I mean, this is literally the, if you like, the definition of money. Central bank liabilities as money, and the central bank can provide that finality of settlement, and thereby lower costs and promote this very vibrant ecosystem that can lower costs and promote financial inclusion. So we can come back to that later. Let me just spend 1 minute on credit, because I'm sure we will discuss this at greater length. And let me just show you this one chart, which is from a working paper that we recently published, which compares the degree of sensitivity of big tech credit, in this case for financial, compared to bank-provided finance, bank loans. And what you see here are the elasticities of credit with respect to, in the pink, house prices, and in the blue with GDP. And the message here is, if you look at that middle panel, whereas bank credit is quite sensitive to house prices, you see that very large pink bar. The same is not true for big tech credit, which is on the left-hand side.
So just to clarify, this is with respect to cycles, right? Basically, what you're saying is that big tech credit is less pro-cyclical with respect to both growth cycles with GDP and real estate cycles with house prices.
Exactly. So that's the key. That's the key phrase, pro-cyclicality. Okay. Yeah. So yes, in a word, big tech credit tends to be less pro-cyclical, and we can come back to this. And there are, I think, a well-based hypotheses as to why this might be the case. If you have user data that can map out the networks of the interactions directly, you may be able to have inroads into better credit assessment, which doesn't rely so much on collateral. That's the kind of punchline. And if we have time, I've prepared some extra slides we can maybe return to. But I guess in terms of the welfare calculation, the issue here is, yes, clearly we can enhance efficiency by utilizing the more detailed information on the users. But we may want to set that against the distributional issues that are going to be raised, in that we know, for example, in the textbook case, that here's an example of, if you like, first-degree price discrimination aspects, where if the monopolist provider can discriminate user by user, of course, it can achieve efficiency, but then will capture that surplus. And in the case of big techs, there is the additional issue as well. Is there also the scope to also to actually change preferences as well? And I think this is something that's been very much in the minds of the policymakers. So just to conclude, I think, and as the title of this session alludes to, perhaps there is a need for a broadening of the discussions here, away from the traditional financial stability types of concerns towards, firstly, the competition aspects, but also the data privacy aspects, both in terms of, if you like, the privacy goals as an end in itself, but also as a way, as a means towards an end, for example, towards financial integrity, towards the integrity of the financial system, and also to prevent illicit activities. And in this respect, I think one debate which is just starting, and here I think the policy debate has led the academic debate to a large degree, is whether we should still think about regulation here as more or less activities-based, which is to say, we think about regulation activity by activity, where we lay down certain criteria which lead to licenses for particular activities, for example, for payment, for credit, and so on. Or should we think of it more in terms of an entity by entity approach, rather than the way that we approach banking regulation? And in the case of banks, we take that entity by entity approach because they have wider repercussions for the economy and the financial system. There are these spillover effects which possibly are best taken into account in an entity by entity approach. In the case of big techs, it goes beyond prudential regulation, perhaps also spilling over into competition and data privacy. And my colleague Fernando Restoy has just published a policy paper on this in the last couple of weeks. I put the link there. And I guess here we do see the beginnings in the major jurisdictions of a move towards a more entity-based approach to regulation. In the US, for example, we know about the House Subcommittee report. Perhaps the European Union is most advanced here. As you know well, Nicola, both the Digital Services Act and the Digital Markets Act, so the legislative proposals were published at the end of last year. The DSA is more about social media, the DMA more about competition aspects, but both have this threshold of 45 million users as being a kind of sort of line that above which these rules would apply. And so this is very much aimed at the big tech world. And I'm sure we'll get to this in China. Also, there's been this move towards a more entity-based approach. So I think the thing to end on is to note that many more questions are raised if we go to an entity-based approach. which go beyond the traditional mandate of financial supervisors in these central banks. So we're going to need a more joined up approach. So I think that very much underlines this holistic term in your title. So let me finish there.
So I have a question, because we've had those discussions over the years, and at some point, if I remember correctly, you had a slightly different depiction of the linkages and the policy relationship, which was not a triangle but a quadrant or compass with an additional dimension, which, if I remember correctly, included things like data security. Can you elaborate a bit on your trajectory of thinking along those lines?
So let me just bring up the slides again. It's incredible that you remember the regulatory compass. So this is, if you like, it's a slightly different way of depicting that regulatory compass. If you recall that regulatory compass, what we laid out there were two axes. I'm not going to even attempt to bring that up, given I might not manage it in time. But so there, the choice was between greater entry. So it's basically a case of this number one, two-way arrow between traditional financial stability concerns, which argued for a more concentrated banking system. And well the argument, Nicola, about why a concentrated banking system is more conducive to financial stability, because the banks are more profitable. The franchise value of the banks, the protection of that franchise value is more conducive to more prudent behavior, and so on, versus the idea that, well, you have a more competitive banking system which will lower costs for consumers, and so on. I think so this is the first dimension of that compass, where if we think about that trade-off in the case of big techs, what we're doing is, yes, if we encourage the entry of big techs into financial services, this will certainly be more conducive to lowering costs, because we can, certainly use that data network activities loop that I began with to lower costs and improve services. And because the financial services industry is still relatively new for the big techs, this will open up those those frontiers. I think what we've seen in the case of China is where I think that entry has proceeded perhaps more fully. We do see that this idea of the walled garden and the closed network has other implications for that welfare calculus, and so I think finding the appropriate balance here, I think, is going to be important. This is why, in the case of the payment services sector, there has been a big push among central banks and among the policymakers in payment services towards a model where the central bank does play a very important role, either providing directly the infrastructure by providing settlement accounts for the fast retail payment system, and trying to mobilize that DNA loop, if you like, trying to channel that DNA loop, data networks activities loop, where the vicious circle of greater entrenchment can somehow be channeled toward the direction of a virtuous circle, where greater entry leads to greater competition, but greater variety. And so you can harness that virtuous network effects without necessarily erecting closed networks, without necessarily giving the pivotal advantage to the incumbent providers, which could later in the day lead to walled gardens and to entrenched interests. So I think that's the one difference I think between. Yeah, I've gone on too long already, so let me.
Not at all. I have tons of questions, and I'm sure so does our audience. So, Rory, over to you.
So, thank you very much, Nicola, for inviting me. I despite the logo behind me, I want to just start with the standard disclaimer that I'm speaking in a personal capacity as a member of the Peterson family rather than as a representative of my current or any of my previous employers. And the other thing I want to say is that I really wanted to appear as a cat today, but I did not manage to pull off the technological feat to do that. So
maybe we'll have to explain that one to the people who are not stuck on Twitter all day, but that's an allusion to an event that happened yesterday.
I think everyone saw that yesterday. So a couple of thoughts about this, what I thought was a very interesting and thought-provoking presentation. So first of all, to start with the very first slide, the pie chart, I think that is a very revealing one, which shows that 11% of big tech's revenue is coming from finance, which also means that 89% is coming from something else. And so the takeaway for me from that chart is that big techs will work very hard not to jeopardize the 89%, regardless of how tempting that 11% looks. And what that means is that there will be a great desire to avoid entering highly regulated industries in any frontal way, certainly in a way that could lead to not just the regulation of the specific subsidiary that's engaged in financial services, but the group as a whole. Because however profitable the financial goose is, it's nothing like the goose in their core businesses that is laying golden eggs every minute. And so in some jurisdictions, you will see big tech firms becoming banks, but I would conjecture that there will be an inverse correlation between the interest of these tech firms in becoming banks and the stringency of financial regulation of those banks. But obviously, we are seeing the entry of big tech into areas of financial services. And in particular, there's a nibbling around the edges that is where they try to take advantage of the adjacency of their business, be it e-commerce, be it social media, to financial services without entering the fully regulated part of the financial services industry, in particular, taking consumer deposits. And so I think that the important thing to understand about tech business models in general is the desire to own the consumer, to own the gateway to a broader marketplace for some commoditized product or service. So, for example, obviously you have platforms like Uber, Airbnb, which they own the consumer, the user interface, but then they offer to the consumer cars or apartments to stay in. And so they are the aggregator. They capture a lot of the value in that relationship, and the providers of the good or service become, more or less undifferentiated providers of suppliers of inputs into that value chain. And so the analogy in the financial sector would be that a Google or an Amazon would probably not want to be the deposit-taking institution, but they could easily offer an app, a front end, that would give consumers a range of choices of different banking service providers. The service providers would be regulated institutions, and they would just be doing the user interface for those institutions. But of course, that has huge implications for the margins, because if all of a sudden a bank is no longer a brand, a trusted brand, but it just becomes essentially a generic bank balance sheet, which is competing with others entirely on price, then the margins that that business can command are potentially much lower, and a lot more of the profitability goes to the tech company that owns the consumer. And so the implication of that is that it's not so much a question of competition versus financial stability, which is one of the arms of that triangle. The trade-off is between competition in the banking sector, which would be heightened in this model, versus competition in other parts of the economy. And so you'd have a concentration of the consumers in this app user experience, but then a lot of competition on the banking side, and that having knock-on implications for banking sector profitability. Just a couple of words on on payments and data sharing. I think that there's a little bit of a conflation of different issues here. As you know, in the payments industry, we talk about open loop versus closed loop systems. An open loop is one that is interoperable. So if you go and pay with a Visa card, chances are you could also pay with a MasterCard at the same place, or an American Express card. That you're not locked in, the acceptance location is not locked into a single scheme. The alternative, these closed loop schemes, for example, the Chinese, where every Chinese merchant has 2 QR codes, one for WeChat Pay, the other for Alipay. And so, naturally in my current seat, I'm a great advocate for open loop. I think that the interoperability does benefit consumers very much, and that there's a natural tendency towards concentration in these closed loop systems. That said, the notion of data sharing is, I think, a very thorny one. It's thorny for a couple of reasons. First of all, because there is a direct challenge to privacy if all of a sudden companies are expected, on the one hand, to protect their users' data, and on the other hand, they're required to share with other entities that may or may not have as stringent data privacy standards as they do. And the second challenge here is that I think that there's perhaps an excessive degree of optimism about the ability of different companies to read one another's data and understand it. So clearly there are standardized forms of data about what transactions you did on what day, and right. So those are things that can be clearly standardized and shared. What is much less easy to share is data that is collected for some specialized purpose. So, for example, Google collecting data on consumers' search histories, or Facebook collecting data on likes. Those are those companies can infer a huge amount about their customers from their own data. Right. But the degree to which anyone else can make inferences about that is very difficult. And anyone who's used a data set created by someone else for a different purpose will understand that without a lot of help from the people who actually assembled the data set, it's just very hard to get your head around it. And I think that that's the reality, is that only for a very narrow set of financial data will this API construct be useful. And you're certainly not going to get to the core data advantages of the big tech firms.
You announced this. You mentioned data portability in your presentation, and you mentioned two modalities: accounting for information services and payment initiation services. Are there any examples of this kind of interoperability working in practice that you'd like to share with us?
Sure. I think Rory makes a very good point that the data come in many different shapes and sizes. I think this is why for example, the principle of data portability by itself is going to be very, it's going to have a limited impact, simply, just as a principle. Because if you get the data as, in a form that's not going to be very useful, as a data dump, as I put it in this in the slide, it's going to be.
So my question is examples.
Yeah. So I think the example that's probably been best publicized is UPI in India. So I think this is the case that has been sort of best publicized because it's often discussed in the same example as the digital ID scheme in India called Aadhaar, which is a biometrics based system. It was rolled out very recently, just over 10 years ago, and it's the identity scheme has has enrolled the bulk of the population, a large proportion of the population, and it is an infrastructure that is operated by the National Payments Corporation of India, but it is very much linked to the central bank and the central bank's balance sheet. I think.
So what is UPI? What does the acronym stand for?
Let's see. So UPI is the system, this open system.
Okay, so it's not a company. It's
a system. The company is called NPCI, the National Payments Corporation of India.
Okay.
Although the Indian case is probably the best known, this is just this particular approach I think is pretty well established. It is perhaps it's less known in the US because unlike those other countries that I mentioned in the slide, this hasn't yet been established in the US. With the FedNow initiative, which is going to be rolled out in a couple of years, this will be a step in that direction. But I think we are.
But again, we've had open banking in the UK and PSD2 in the EU. I mean, we have all these pieces of legislation. Some of them have been enacted, 2-3 years ago. So now there is some experience of having that legislation into force. Has it already led to success stories, or not really?
Yeah. So I think if you travel to some of these countries, I think it's it's something that is already operating pretty successfully. I think in Asia, you see that operating now in several countries, in those countries that I mentioned in my slide. But also, what I point to is in the two success cases in the Americas. The one is in Mexico, the system called CODI, and in Brazil, which has just started, this system called PIX. How
do you assess success?
Pardon?
How do you assess success? What metric makes them successful?
Yes, I guess the cost, the participation, and the convenience. I think what's going to be crucial is the user experience, the look and feel. And I do fully agree with Rory that it's going to be, the full range of data is going to be a challenge. But as you said, there is a core set of data. For example, if you open one app, you can check your bank balances in all your other accounts in the same system. That's an example of AIS, Account Information Service. So if you have several bank accounts, you don't have to open all these different apps to check your balances there. You can just open one app in any of your banks and then check the balances in all of your accounts. And with the PIS, with the Payment Initiation Service, you can actually, authenticate, who you are and execute payment, from any of your bank accounts to any other, members in the system. I think one issue that is going to be probably a fork in the road for the policy is who does, so who should the central bank admit to this infrastructure? Should it be the banks only, and traditionally it's been very much a bank-based system, as you know, or should the central bank open the doors to a wider range of payment service providers? And here I think we have seen a divergence. Even within Europe, as you know, in the UK, the Bank of England has opened the Bank of England settlement accounts to non-bank PSPs. That's not the case in other jurisdictions. I think in the US, for example, this is still something that is being debated, but it's not yet in place. And I think there are some very important debates there.
Okay.
So I think there are some big issues here.
I have tons of questions from the audience
Sure.
now, which is good. And many questions are about this notion of entity regulation into big tech, not big tech space. And especially, those big tech firms are already regulated by competition regulators in many ways, and by data regulators increasingly, and now they get regulated by financial regulators. So that gives rise to a lot of questions. For example, Fabrizio Goria asked whether the notion of too big to fail applies to big tech, and especially cloud service providers. Similarly, Mark Rubinstein asked about whether cloud service providers should be labeled systemically important market utilities. And we have several other questions along those lines. So maybe Rory and Zhen-Yun, what is your view of this, and how do you see things emerging? There are many legislative debates, the so-called DORA legislation in the EU. Are we getting to a point where cloud service providers, which often are the same firms as the big tech data platforms, will become increasingly regulated under the financial framework? Maybe Rory first.
Yeah, I think that clearly, if you have an enormous infrastructure provider that represents a systemic, a potential systemic risk to an entire financial system, you're going to want to include that in the regulatory perimeter. And the only question is whether regulators actually know how to do that, whether they know how to evaluate the kinds of risks faced by these cloud service providers. And frankly, some of the risks will be potentially posed by governments rather than by technological failure or by hacking. So it's there's no question that when you have maybe 3 cloud service providers for an entire banking system, that's something that regulators are going to have to think about.
When you say government, can you elaborate?
Well, I'm just saying that what we now know is that the most sophisticated cyber attacks in the world are launched by state entities rather than by the proverbial person in New Jersey sitting on his bed.
But is that the only risk? There's what I think is a pretty thoughtful question from Giuseppe Bruno on the Q&A. I would like to ask whether data sharing between big tech and public institutions with a high reputation in confidentiality can be envisaged, and in case of a yes, how would you implement that?
So it's interesting. I've been involved in some of those conversations in my last couple of jobs, and there are examples, very good examples of tech companies sharing data to assist in public policy, but they have all, to my knowledge, been voluntary, and there are reputational reasons and just a desire for good things to happen that will lead tech companies to be willing to share data. My point earlier is that you really need a high level of voluntary cooperation in order to make that work, because the data on its own is actually really, really hard to interpret, hard to generate useful insights out of. And so the best models, I think, are ones in which either because they're being compensated for it or because they're doing it voluntarily for to enhance their reputation, you get companies working hand in hand with the government. I think that much more difficult would be some kind of mandatory system where it's just not clear that you'd get beyond what Hyun referred to as the data dump problem.
That's super interesting, and I cannot resist following up on that thought, and I'll return to Hyun later. But isn't that necessarily linking to some form of economic nationalism and corporate nationalism? Because you would imagine that a US big tech would cooperate voluntarily more with the US government than a German big tech with the German government and a Chinese big tech with the Chinese government. And to a certain extent, I think we're seeing a little bit of that on what you call elegantly voluntary cooperation. So doesn't that inevitably over the medium term lead to fragmentation, or is there a way to implement that kind of voluntary cooperation in a non-exclusive manner with the home country?
I don't think that follows at all, frankly. I think that all multinational companies are concerned about the country, their relationships with the governments of the countries in which they are operating. And so while it's hard to imagine an American company sharing American data with the government of India, there's probably got to be a very high desire on the part of that company to share Indian data with the government of India, because India can be a challenging operating environment. And so they will be very keen on establishing a good relationship with the local government. So I don't think that it necessarily encourages any kind of nationalism.
But I understand the theory, but when we look at the practice, isn't all the evidence pointing in the direction I suggested?
No, not at all. Not at all. I think that, and now I can just speak for MasterCard. I mean, we have, over the course of the pandemic, for example, we have a lot of very high frequency and recent data on economic trends, on retail sales trends. And we have worked with dozens of governments around the world during the pandemic to help them to understand what the impact has been on their citizens, all the way down to the municipal level. We've been working with cities as well. So I really don't see that.
That's right. And I should mention that some of the data has been made public and has been very useful to researchers in the organizations I know best.
Nicola, if I can just jump in here, Rory's data, well, it's not actually Rory's data, but the data from the credit card companies, we have also used them in our research publications. There have been a couple of bulletins that we've published that illustrate various points, with that data series as well.
But Hyun, how do you think about this question of the linkages between the companies and the governments? Because that's kind of in the background of many of those debates, and I don't want to focus exclusively on it, but I think it's one of the big issues right now, and it spills over on all kinds of different issues. Fabrizio Goria asked also about taxation. I mean, we know that this is kind of the elephant in the room. So how is it? What's your frame looking at it from Basel?
So, let me answer this with by putting this into a larger context. That a very high-profile agenda item on the G20 on the G20 work plan is to enhance cross-border payments. So this was initiated last year under the Saudi presidency, and it's going to get a big boost this year under the Italian presidency. And when we look, and the BIS is either leading or co-leading 11 of those 19 building blocks, so-called. And one thing which really emerges as being a very important feature in that work is that when you try to superimpose the intuitions that come from a national payment system to the global context, you quickly bump up against some very big differences. So, for example, something as basic as personal identity. In a national payment system, the banks are the guardians, if you like. They are the curators of personal identity. because they have your account information. And then it's a matter of just combining that with the other databases that the country has. For example, if the country has a national ID system, it's just a matter of combining those. You'll get it's a detailed picture, and indeed this would be a great boost for financial inclusion if you can actually establish identity. This is a way of opening up financial services. This is the big selling point of Aadhaar that I mentioned earlier in India. Now, if you try and do that in the global context, just imagine what's involved there. So what you need to do is to knit together the separate national ID systems, across the world. So if you were to try and replicate in the global context, what we already have in a national context, you need some way of knitting together the personal IDs of all the participants in the financial system in all the countries in the world. Now, what is a practical way that you might do that? Well, typically what's happened so far is that we've used the system of correspondent bank. So we try and piggyback on what we have already and find points of entry where you go from point A to point B by going through the correspondent banking network, where you have banks that are customers of each other to form a chain. And this is where a lot of the high costs and the bottlenecks come. And this is what the G20 has been trying now for a very long time to actually improve. So something as basic as personal identity in this global context is going to be very, very challenging. I mean,
you didn't mention the legal entity identifier, which has been a big effort of the last 10 years. Is that an intentional omission?
No, the legal entity identifier work is still going on, and but let's just take that example. Suppose we were to complete the legal entity identifier work to its logical conclusion. Can we imagine a global database of all the individuals in the world? Now, I think we can imagine it, but then think about what will be involved in the governance structure for that kind of database. Who would be in charge? Who would be sufficiently trustworthy? Who would command sufficient consensus among all the interested parties to be able to oversee that kind of database? And if we cannot find if we cannot find one entity, is there another way that we can organize the identities of everyone in the financial system so that we can build this borderless payment system? And you can imagine, some kind of decentralized consensus system. Maybe we can be very clever with some kind of blockchain, although there'll be many, many technical hurdles as well as conceptual hurdles there. So even there, you already see the challenges that are going to be thrown out for something as basic as a payment system. And this is even stopping short of all the considerations that have to do with protecting your national champions in various industries, or national security interests, and anti-money laundering and other illicit activities as well. So I would just put that out there, Nicola, because I think this is going to become, I think, more prominent as we do this work. That we will be, there'll be a premium on trust and cooperation across across the world as we embark on this on this work.
I have a question from Martin Trozempa on the recent experience in China about separation, what the US parlance who calls the separation of banking and commerce. And obviously we've seen, the my choice of words, regulatory crackdown on Ant Group and the imposition of a much clearer separation in that respect between the e-commerce arm of the group and the financial arm. So what's your reading of those tea leaves, if I could put it that way, and do you think it's transposable to other jurisdictions? Yoon?
Yeah, so I think, as I said briefly in my opening remarks, probably China is the jurisdiction where the entry of big techs into financial services has, progressed most. And I think there are the issues. I think, Martin's question about the separation of commerce and banking, I think, is a very good, starting point for that discussion. Now, why do we have these regulations? Why do we have these rules that separate banking from commerce? And they have to do with the special nature of banking. And Nicola, you're one of the world's experts on this. When we think about the systemic nature of banks, the reason why we have, even in many jurisdictions, a separate a separate legal framework for banks. We have the resolution of banks being governed by specialist banking laws rather than going under the usual corporate bankruptcy proceedings, for example. Why do we do that? Well, it's because banks are very special. They have these tremendous they are a very important industry with a lot of spillover effects to the rest of the financial system. This is why we regulate them. They also take deposits from ordinary depositors, and so given the systemic nature, there's always been this imperative that we need to make sure that the spillover effects, the externalities that are generated.
So you think, if I hear you, you're saying that we'll see more tightening of this separation going forward in more jurisdictions. Do I hear you well?
Well, I'm not sure I would describe it that way. I think if in those jurisdictions where the starting point is very much an open market like the one that I described. I think India is a good example where they have set the system up from a very from scratch, if you like, in this open way. The big tech companies are there. They do operate, but they plug into the system through the open infrastructure. For example, Google Pay is a member of UPI in India, but they they are one of many payment service providers. So I think if the infrastructure is geared towards that kind of open system based fundamentally on the central bank's balance sheet, then I think the preconditions are already there, and you will not need. Well, I mean, it's not a case of tightening there. It's if you like, the basic tenets will already be being followed there.
Right.
I think if in the case of China, I think it's I think that was an example where the two big players grew very rapidly. I mean, this sort of gives a sense of the of the economic force that drives the DNA loop. It's a kind of good illustration of the power of that loop, that they grew so fast and so large in such a short time.
Right.
But I think, but the debate that that Martin is also very familiar with, which is on the central bank digital currency debate, and the ECNY, which is I know is another topic that you've covered, is, if you like, part of that that overall policy discussion where if the future is in digital payments and in a digital infrastructure, what is what are the ways where you can reclaim that public space? What are the ways that you can reclaim the nature of the payment system as a public good that's open, and in a way that can enhance that virtuous circle where you have greater entry and nevertheless you can still capture those network effects. So how do you turn the DNA loop into a virtuous circle? I think that's been the key policy discussion.
Rory, what's your reading of the Ant Group saga and this whole question of separation of banking and commerce looked at from an international perspective?
Yeah, so first of all, I will say that I've learned more about this from Martin than from anyone else as a little bit of an ad for Peterson colleagues. My reading of that history is that the companies flourished under conditions of benign neglect by the regulators. And the regulators then suddenly woke up to the fact that they had two enormous entities that were not only potential financial systemic risks, but also were so large and so powerful that, you know, that raised political questions for the Chinese Communist Party. At which point, the authorities there did a U-turn and decided to reassert the primacy of the banks in the payment system, and including through this creation of the DCEP digital currency, which is a bank-based currency that in some ways is a direct competitor to WeChat Pay and Alipay, the two predominant private big tech dominated payment systems in China. So all of it, which is to say, China, I think, is the exception that proves the rule about what big tech wants to do in the financial sector, because it marched into finance exactly because it didn't face significant regulations. And now the regulations have come back, and big tech is on the retreat. I think that is actually a useful lesson for the rest of the world, that you're not going to see big tech voluntarily subjecting itself to the scrutiny of central banks, or certainly not voluntarily subjecting their entire operations to the scrutiny of central banks, just in order to capture the relatively low margins and low returns that the financial businesses offer.
I think that's a great tentative conclusion for our debate, because we're on time. And I apologize to the audience that I haven't been very good at helping our speakers to address all the questions that were asked, but lots of food for thought there, and we'll come back to this, to the many themes of this discussion, because actually we've been all over the place, and I think we'll continue to be for some time, because there are so many moving, fast-moving pieces to this debate, and especially, for example, the point about activities versus entities is one to which I think we will return quite soon. Our next session in this financial statement series is going to be on February 24, and we'll discuss the role of central bank, not in terms of creating digital currencies, but more generally in terms of being very activist in credit allocation and more broadly capital allocation in recent times. So Steve Cecchetti, your predecessor, Hugh, at the Bank of International Settlements, will be there, and also Sina Krogstrup, who is one of the members of the Board of Governors of the National Bank of Denmark, and of course a former colleague at the Peterson Institute. Thanks so much to our two speakers today for what I thought was an extremely thought-provoking discussion. And again, all the blame for not being able to address all the different moving parts is mine. Have a very good rest of your days wherever you are in the world, and looking forward to seeing you soon again at the Peterson Institute. Thanks very much.
Thanks very much.